Hi, my name is Kanwal Sarai and welcome to this video. In this video I'm going to show you how to use the Simply Investing report. First, I'm going to quickly go over a couple of definitions here just to make sure we're all on the same page. Then we're going to talk about buying low and selling high. Quickly go over the 12 rules of Simply Investing. And then we're going to actually look at the Simply Investing report. It's available in a PDF format and in an Excel format, and we'll look at both of those. So what is a stock or a share? A stock represents ownership in a company. Microsoft, for example, has a little over 7.9 billion shares outstanding. If you were to buy all 7.9 billion shares, you would own the entire company. But when you go out and buy 5 shares, 10, or even 100 shares, you're buying a small ownership in the company, but it's still an ownership nevertheless. As part owner of the company, you are entitled to share in the profits of the company. Which brings us to the next section, dividends. So a dividend is the company sharing its profits with you, the shareholder. So for example, let's say a company is paying a dividend of $1 per share and you own 1,000 shares. You will receive $1,000 each year in dividends, and this is a cash payment that's deposited directly into your trading account. You can take this money and spend it if you wish, or you can reinvest it. It's entirely up to you. But as long as you own those shares, and as long as the company continues to pay $1 a dividend per share, you will continue to earn $1,000 every year. Now let's say, for example, there's another company that is paying $2 per share, and you own 1,000 shares, you will receive $2,000 each year in dividends. So the dividend yield is quite simply the dividend divided by the share price. So if we look at the same example we were looking previously, and if the company is paying $1 a dividend per share, and the share price today is $20, your dividend yield would be 5%. So it's 1 divided by 20, which is 0.05, and we convert that into a percentage, and we end up with 5%. So what does the 5% mean? It basically means that this is the return on your investment. So let's say you invested $5,000 in this company and you bought shares at $20 each and the dividend was $1 per share. Then 5% of your initial investment is going to be $250 in dividends each year. Now, regardless of the stock price, throughout the year, the stock price can go up or down, but as long as the company continues to pay $1 dividend and you bought the shares at $20, your dividend yield is going to be 5%. In other words, a $5,000 investment would mean you'd buy 250 shares at $20 a piece. Each of those shares gives you a dividend of $1, which again is $250 in dividends each year. Now, what would happen if the share price, say, dropped to $15? You'll notice that the dividend yield has now gone up to 6.6%. Now let's say you wait a couple more days and the share price drops to $10 or even $5, right? So notice what's happening to the dividend yield as the share price is getting less and less. All things considered equal, is it better to buy the shares at $5 each, or is it better to buy the shares at $20 each? So obviously it's better at $5 a piece because your dividend yield is going to be 20% instead of 5. So you're going to make a lot more money on your initial investment. So it's always good to buy shares when they're priced low. So to summarize here, and this is very, very important, so please don't proceed further in the video until you understand this, so I'm going to repeat it again. You can see that as the share price continues to drop, and in this example we've gone from $20 down to $15, down to $10, down to $5 a share. So as the share price continues to go down, the dividend yield continues to go higher. And the reverse is true. As the share price starts creeping up again, the dividend yield is going to go down. Okay, I call this the law of dividends. So everybody says you want to buy low and sell high. But what does that really mean? You want to buy low in this example, you'd want to buy the shares at $14 a piece and then turn around and sell them later on at $51 a piece. And the reason you want to do this is going to maximize your profits. So you want to buy low and sell high. Now, how do you know when a stock is priced low and how do you know when it's priced high? So we're going to look at that right now. So again, the law of dividends is what's going to help us to determine when a stock is undervalued and when a stock is overvalued. So stock prices go up and down all the time. What if I was to tell you in this example, for this particular company, the average dividend yield over the last 10 years or more has been 4.5%. Then you'd want to buy the stock preferably in the gray area here, anywhere below the dotted line, because that's where the stock price is low. Anywhere above the dotted line, the stock price is going to be high. So for example, if you were to look at this company today and the current dividend yield was 8%, you would compare that to the average and you'd say, okay, well, the current yield is 8% and it's much higher than the average yield of 4.5%. So yeah, the stock is undervalued. It's probably a good time to buy the stock at its current price. On the other hand, if you were to look at this stock and the current dividend yield was 2.5%, then you know the stock is priced high because the current dividend yield is less than the average dividend yield. Okay, so we're going to summarize that again, and this is also very important. We've got it highlighted in bold here. The stock is undervalued when its current dividend yield is greater than its average dividend yield. And the stock is overvalued when its current dividend yield is less than its average dividend yield. Okay, so this is extremely important. So now you know exactly when a stock is priced low, when it's undervalued, and when it's priced high, when it's overvalued. Now in the Simply Investing report, we track 110 stocks each month, and we've made it really easy by putting stocks into two separate tables. We've got an undervalued table and an overvalued table. So if you're considering to buy some stocks, you'd look at the undervalued table first. If there's anything you're thinking about selling, you'd want to check and see if it was in the overvalued section. If there's a stock you're thinking of buying and it's in the overvalued section, then you would for now have to skip it because you don't want to be buying stocks when they're overpriced. Now in the Simply Investing report, we take things a little bit further. Even though looking at the current dividend yield and comparing it to the average yield is a good approximation to know when a stock is priced low and when a stock is priced high, but how do you know when is it a good time to buy exactly? So in the same example here, what if I was to tell you that the current yield today was 6%, right? So 6% is certainly higher than the average dividend yield of 4.5%. So yeah, the stock is kind of priced low, but what if the dividend yield was 7% or 8%? It gets a little bit more difficult to determine, okay, is the stock really priced low, or is it just a little bit undervalued today? So to help us with that, in the Simply Investing report, we take things a little bit further and we provide you with two other values that are going to be very helpful to you. So we provide you with the average high dividend yield. So over the last 10 years or more, okay, we look back and we determine what is the average high dividend yield. So in this example, the average high dividend yield is 10%. So now you know if the current yield today is only 6%, the stock really isn't that much undervalued because on average, the high dividend yield has been 10. So when it gets close to 10, maybe 9.5%, maybe 9%, or even 10.5%, that is going to be the ideal time to buy the stock. And then the other value we provide you is with the average low dividend yield. And in this example, it's 1.2%. That's going to give you a much better indication of when to sell, right? So when the current yield gets close to 1%, 1.2, or even 0.9, then you know, okay, the stock is really overvalued and that's going to be a better time to sell. So in the Simply Investing report, we provide all three of these values. In addition to that, you can see on the screen here, there's 25 metrics in total that we are tracking every month for 110 stocks. And this is the critical stuff that you want to look at, the most important stuff to help you decide whether or not you want to make an investment. Everything else is just noise. The 12 rules of Simply Investing. This is something that I've designed. We cover it in a lot of detail in our online Simply Investing course. So if you're looking to learn more about this, I would encourage you to sign up and take our Simply Investing online course. But for today, I'm going to just sort of go over it very quickly. You can see the 12 rules on the screen here. I'm not going to read them all out. They're available to you here. And again, if you wanted more information, we do cover them in great detail in the Simply Investing online course. But what you're going to notice here is I've highlighted the 9 sort of criteria, or 9 of the rules here in bold. And I'll go through those right now. So the first one is, has the company had consistent earnings growth? So the EPS growth must be at least 8% or greater. The next one is the dividend growth must be at least 8% or more. The payout ratio must be 75% or less. The debt must be 70% or less. The credit rating, we're looking for a BBB plus or better. Does the company actively buy back its shares? P ratio must be below 25. The current dividend yield must be higher than the average dividend yield, and that's one of the best indicators to know when a stock is undervalued. And the P ratio should be 3 or less. So these 9 criterias are quantitative. These are things that we can automatically calculate for you in the report, and we do that. And in the Simply Investing report, we're going to look at it in just a minute here. So we do identify the Simply Investing criteria, the SI criteria, out of 9. So a company that matches all of these will get a rating 9 out of 9. A company that's matching just 8 will get 8 out of 9, and so forth. These 12 rules are designed to keep you out of trouble. They're designed to minimize your risk, maximize your return. I've been using these for more than 17 years personally in investing, and I highly recommend sticking to these 12 rules. So in addition to the 9 criteria, the quantitative things that we can measure, the rest of the rules here are just as important. So just to summarize, before we jump into the report here, we track each month 110 stocks. The SI criteria out of 9 is going to be listed in the report. We're going to tell you exactly which stocks are undervalued. We're going to tell you exactly which stocks are overvalued. And we're going to give you the 25 metrics for each stock every month. 60 stocks are going to be in the US market and 50 will be in the Canadian market. So the report is available each month in PDF format and in Excel. Our subscribers can log in. They can download both of these formats, or whichever one you prefer. They're both available to you every month. If you want to take a look at a free sample report, head on over to simplyinvesting.com/report. So let's jump into the Simply Investing report. We'll look at the PDF first, and then we'll look at the Excel file. Up on the screen now is the Simply Investing report in the PDF format. So you'll notice on the first page, we have a list of 5 US stocks and a list of 5 Canadian stocks. So what we've done here on the first page is provide you with a list of stocks that have met all or most of the 9 quantitative rules of Simply Investing. Those are the 9 criteria we talked about earlier. We've listed these stocks from highest dividend growth to lowest dividend growth. So you want to focus on the ones that have the highest growth first. In the long term, these stocks have the highest potential for capital appreciation and dividend growth. So if you're looking to start off and build a portfolio today, these are the stocks that you would consider first. So we've listed 5 US stocks and 5 Canadian stocks. Next, we have a list of undervalued US stocks. Now, this month in particular, we had a big list, so there was 40 stocks that were undervalued. So they don't fit all on one page, so we've split the table up into 2. So we've got part 1 here, and we've got part 2 here. So this is a list of undervalued US stocks. So in the event that you already have these 5 companies, or you're looking at other companies aside from these 5, then this is a table where you want to start off with. I'd recommend looking at the criteria column first and look at the companies that have a criteria of 9 out of 9 or 8 out of 9. Start with those first, and then focus on the 12 rules of Simply Investing. So you want to look at EPS growth, dividend growth, payout ratio, the amount of debt that a company has, the P ratio, and so forth. So this is where you would look, and you can pick out additional companies that might be of interest to you. Now again, every month we will provide you with 5 US stocks and 5 Canadian stocks that we feel have the highest potential for capital appreciation and dividend growth in the long term. So this is where you really want to start and picking off companies here. But once you've built a portfolio, a substantial portfolio, and you've got all of these companies here, then the undervalued table is where you want to go to next. Now in PDF format, we're limited to the page size here. There's 7 other columns of information that we want to put into the table. So that's going to be available here. So additional information on the same undervalued stocks that you saw previously. So we've given you the EPS, industry, dividends paid, since, consecutive years of dividend increases, and a whole lot of other information here as well. So the additional information carries over to this page. Next, we have our overvalued table. So these are stocks, if you own them, you may want to consider selling. If you don't own them and you're thinking about buying stocks that are on this table, our recommendation is to hold off on that. Would not recommend buying anything on this table today. These are stocks that are overvalued, they're overpriced. You want to wait till they move into the undervalued table before considering any of them for purchase. So again, with the overvalued table, there are 7 additional columns that don't fit on this page, so we've put them over into the next page. So it's the same stocks that are overvalued with additional columns here. Next, we show the Canadian stocks. This month, we have 34 Canadian stocks that are undervalued. So you can see all of the information is here. Again, if you've looked at the 5 stocks on the first page, you already own some of them, or you're looking for other ideas, this is the table you want to come to. And again, as I said before, focus on the ones that have a criteria 9 out of 9 or 8 out of 9, and focus on those companies first. Those would be the ones you want to consider for purchase. On the next page, we have the 7 additional columns for the companies that are undervalued. Next, the overvalued stocks are listed here, and then the 7 columns for those overvalued stocks, the additional columns, are listed here. On the next page, on the left-hand side, we have the Simply Investing perspective. So this is an area that allows me to communicate directly to our subscribers. I can tell you a little bit about where the markets are at, what has happened, and so this is a great place for me to communicate with you some ideas, thoughts that I have, and I can put them in here. On the right side, we have some other information about building your portfolio. And at the bottom left-hand corner here, this will identify when the next issue is coming up. So you want to keep an eye on that. On the next page, we have some more information for you on the left-hand side. On the right-hand side, we do have the 12 rules of Simply Investing. So those are here. Again, for anybody looking to get more information on these rules, we go through them step by step in the online Simply Investing course. And on the last page of the report, we have all of the table headings, all the column headings that you've seen in the pages above with all of the definitions. So now let's go take a look at the Excel file. This is also available for download for all of our subscribers. The Excel file, we've got 2 worksheets. The first one has the US stocks. So these are the 60 US stocks that are undervalued and overvalued. We've given you the entire table. And then on the next worksheet, we have the Canadian stocks. So there's 50 stocks in this list. The great thing about having this in Excel format is all of the columns are here, all on one page, and you can then sort on any of these columns. So for example, if I wanted to look at companies that have the highest dividend growth, I could select the column, sort from largest to smallest, expand the selection yes, and now it's going to give me the list of companies sorted from highest dividend growth to the lowest. Okay, and you can do that with any of these columns. If you have any other questions about the Simply Investing report or the Simply Investing online course, or any other questions in general, feel free to get in touch with me. My contact information is all available on my website at simplyinvesting.com. And thanks for watching.